Well, welcome back to TuckerAllen Live. Of course, I'm your moderator. I'm Scott Trout. And as usual, on Fridays at 1 o'clock, we come to you and bring you just 15 minutes, the latest from TuckerAllen and the attorneys over there. And I'm joined today by Missy Manning in the St. Louis area. Welcome, Missy.
Hi, thanks, Scott.
Hey, thanks for joining. So today we're going to talk about something which is no one's favorite, and that is taxes, obviously. And no one wants to talk about that, and it's coming up perhaps in April, maybe be extended, but as it relates to estate planning. And so as I remind you, you can find out more information about TuckerAllen, not only here on our social media, but also TuckerAllen.com. And if you have questions as you're watching, make sure to submit those in the comment section. I'll be watching. We'll try to answer those for you in the short time that we have with you. So, all right, let's talk about it. Let's talk about the words that most people hear and associate with estate planning, and that is death taxes. Kind of, what is it? How does it work?
The estate tax is also called the death tax. It just means that if your total assets in your taxable estate after you pass away is over 11.5 million for an individual in 2020 or 11.7 million in 2021, anything over that amount will be taxed at a much higher tax threshold. Below that, there's no estate tax for the federal level. Above it, it is about 40% tax rate.
So I know that the death tax, I know there was a conversation during the presidential campaign of whether or not they may change. So I'd caution everyone to kind of keep an eye on it if that's something that concerns you. But are there issues? What happens, like if I exceed that limit, what happens over the limits that you just suggested? What kind of taxes are involved? What can, things get affected by that?
So if you're over the limit, let's say you've got $15 million, anything up to that $11.5 million threshold, there's no taxes on it federally. If you live in a state where there's a state tax threshold, you may have to worry about that one. There's none here in Missouri. If it's over that amount, you're going to be looking at paying 40% taxes on anything over that 11.5 million. Remember that this is the year that you pass away in, so we're never really sure when that's going to happen. So you just got to kind of wait and see. Like you said, it may end up changing in the future. It's something that Congress likes to play around with occasionally. If you think you are going to be over that limit and you're one of the 1% of Americans that this would affect, there are various strategies you can do to take care of avoiding those taxes.
So gifting, I've heard that's a way to kind of eliminate it, and ILIT, which is that life insurance trust that some people mention. What are those two things, and how does that help?
Correct. So every year, you as an individual can give away up to $15,000 to any other individual. Charities are excluded from that, without having to worry about it impacting your $11.5 million estate tax threshold. So you could give some money to your relatives. If you have a spouse, they can double up on that as well. So you can get $30,000 away to that individual between the two of you. So that's one way to start distributing your wealth before you pass away to reduce the amount of assets you have. Another one you mentioned is an ILIT, I-L-I-T. It stands for Irrevocable Life Insurance Trust. So if you have a life insurance policy that's going to be fairly substantial, you can shift that over into an irrevocable trust so that when you pass away, that money isn't owned by you and therefore doesn't count towards your countable assets to that $11.5 million.
Gotcha. So that life insurance policy could throw you right over the limit itself if you have other assets that need to be considered by it, right?
Correct. And then one thing I haven't mentioned already was that if you have a spouse, you have your own $11.5 million and your spouse has their own $11.5 million. And if you don't end up using all of yours, you can pass your exemption limit that's not used over to your spouse. So when they pass away, they have a higher limit to have.
I get it. It's a nice problem to have, but with proper planning, you can take care of it. So that's good. So if let's just say for the most, and we talked about the 1%, but everyone else, are there other tax issues that they should be concerned about with estate planning?
Sure. So most people aren't going to have to worry about that estate tax limit. What we usually worry about with them is reducing their income taxes. So while you're alive and you don't have a trust or anything like that, you just continue to pay your normal income taxes on your 1040, just like every other person. If you do have a revocable trust and you put assets into your revocable trust, then there are still no taxes that you have to worry about while you're alive, because all of that stuff is still going to go on your personal taxes. Technically, the trust owns it, like your house or your investment account or something like that. But for the IRS, they don't consider that to be a separate entity. It's all still going to go on your personal tax return.
So after death, what are there issues that are different than what you just described?
Sure. So after you pass away, again, we worry about that estate tax limit of the 11.5 million right now, 11.7 starting in January. But someone's going to have to file your tax return for you because obviously you're not alive to do that anymore. Another thing to think about is if you're going to be keeping money in the trust over a long period of time, maybe you've got minor children, you've got a situation where you want to keep the money in the trust and not outright distribute it to your relatives, you may be looking at trust tax rates instead of individual tax rates.
I wasn't really avoiding it, but I'm pretty good at procrastinating. I needed a trust. When I found TuckerAllen, all our questions were answered, all of our fears allayed.
You want your wishes in place, so there's no guessing, no stress on the children.
Basically, they talk about what you need, what's important to you. It was more conversational, really very simple.
So, I mean, we've talked about a lot during this TuckerAllen Live segment, it kind of, as I'm listening to you, it almost reemphasizes this whole notion of meeting with an attorney rather than pulling off a will or a trust right off the internet, because you may run into these issues. I mean, they are complicated. So certainly that's something we always recommend, and I've always said, and you do the same, that is find an attorney that practices exclusively in this area and just have a consultation, talk about taxes, because no one likes it. Death and taxes, the two worst things you can imagine. They combine together to make a really, really terrible moment. So how does the gift tax work? If I send something above that threshold, I can't remember, did you say it's 15,000?
So it is 15,000 right now and for next year as well. Okay. You can actually give away more than that to an individual person. You just have to file a report to the IRS saying that you're now dipping into your $11.5 million gift tax threshold. So when you pass away, it's not going to be $11.5 million anymore. It's going to be slightly less than that because you've already used that part of it. But you get 15,000 for free every year.
So if I were to give 20,000, let's just say 5,000, you're not going to pay a gift tax per se on it. It just reduces that threshold if you're going to exceed it. Mm-hmm. So for those individuals, it's an interesting thought that won't even get near that $11.5 million threshold. Should they be mindful of the gift tax perhaps, or are they just kind of free to just start giving that kind of those money away? I mean, I guess it gets a little complicated, but that question came to mind. I'm sure people are listening thinking about that.
So technically, you are required to file a form with the IRS with your tax return if you give away more than $15,000 to an individual, just you personally, and you're not using a spouse. At the end of the day, though, whether that form actually gets filed is, up in the air. I don't think the IRS is going to be checking into someone that has $200,000 worth of assets.
Right. And so is there a technical tax that could be paid, or is it still go against the cap?
Goes against the cap.
I see. Okay. So they should file the form, and there doesn't seem to be any kind of penalty for filing it itself, and you're just following the rules. And if you're never going to hit that cap, it seems okay. So, I mean, I think, again, if you're thinking about it, and I know that could even get complicated with some of the Medicare planning or Medicaid planning you talk about, and that people always think on the elder law side. So I think that's always kind of a great conversation to have with you or some of the other attorneys at TuckerAllen to make some appropriate planning strategies to make sure you can give the money where it should go rather than the government. So that's a good thought. So there's some question about that. You mentioned the $15,000 cap. Is it per spouse, or is it together if you're married, or is it just one amount?
It's per spouse, per individual. And if you've got your own spouse next to you and they want to give to the exact same person, you guys can do $30,000 to that one individual person.
And it's a calendar year?
Yes.
Okay. So does it mean the $15,000 in cash value, anything? If I give them a car, how is that assessed? I mean, I assume I just assess a value to it, and reasonable, I guess, arm's length transaction, right?
Yeah, so if we want to get into technical details like that, I'd refer you to a CPA, and they've got all kinds of cool tools in their toolbox to help you value those gifts.
Right. All right, so let's talk about IRAs. I know one time, I think a couple months ago, we had a question about how IRAs are treated and who pays the taxes if they're inherited by the kids. So what goes on with the IRAs and other retirement accounts?
Okay, so when we say IRAs, we're talking about qualified IRAs with pre-tax dollars. So if it's a Roth IRA, this does not apply because you've already paid those taxes when you put the money into that Roth IRA. So traditional 401k sort of setup here. When you take that money out, you have to report that on your income taxes and pay income taxes on it because you haven't paid taxes on that money yet. Same thing when you pass it on to your beneficiaries and family. They take that money out of your inherited traditional IRA account. They have to pay taxes on that at their individual tax rate, not yours because you've passed away. However much they get out, they report on their taxes and they pay their individual taxes at their own tax rate.
So that's part of the planning that goes in with the will and the trust and just kind of making it apparent, hey, here's what's going to happen with those funds when they're passed along, right?
Correct. And there's some pretty cool strategies that we can do. If you have a child who makes a lot of money and a child who doesn't make a lot of money, they've got different tax rates. They might be getting the same amount of money out of that traditional IRA, but we might want the one with the lower tax rate to get the money out of that, and then the one with the higher tax rate to get money from somewhere else. So that way you're minimizing the amount of taxes that are paid.
Yeah, last week we talked about POD, TOD, the effective strategies using that and kind of the imbalance perhaps, which I've seen personally where someone who dies gives an asset, and it's an unequal asset and they didn't intend it to be. They wanted the assets to be equal, divided among all the kids, but it just turned out one stock went through the roof. And so someone would ultimately benefit, but if it done appropriately through great planning like you suggest, you could equalize it, right? Good. Well, Missy, thanks again for joining. I guess, it's the one thing that no one wants to talk about, but it's so important. When utilized appropriately and planned accordingly, you can kind of take that part out of the equation. So thanks for joining here on TuckerAllen Live.
All right. Thanks, Scott.
Well, as usual, try to bring you just small snippets of information. It does not replace an actual consultation. We don't want you to think that this is in any way legal advice. It gets so technical, especially when we get into getting with a CPA and working in conjunction with your accountant to make sure that we effectively plan for you. So again, educational information only, does not replace just a conversation. If you want to have a consult with us, obviously, get to our website, TuckerAllen.com. You can schedule one right there. You get all the information that you need, including some of the fees that are charged for some of the instruments that we can draft for you, as we've talked about here on TuckerAllen Live. So go to TuckerAllen.com. You'll find out more information. Again, join us here in 2 weeks. Next week is our holiday week. We'll be taking that Friday off and hope you enjoy your time with your family. So until next time in 2 weeks, we'll see you right back here on TuckerAllen Live in 2 weeks from today. Until then, have a great holiday and enjoy your weekend.